Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. I'm your host, Yannis Papadakis, and today we are thrilled to sit down with Benjamin Carmona and Ehud Gersten, managing partners at Perch Wealth. Before we dive in, though, let's hear a little bit about our guests. Ben Carmona is a managing partner at Perch Wealth. With more than 20 years of applied experience, Ben is an expert in real estate investments, structures, and strategies. During his tenure at some of the most prominent industry-leading investment management firms, including Cantor Fitzgerald, Next Point Advisors, and Capital Square Advisors, Ben was involved in acquisitions, finance, due diligence, underwriting, product structuring, syndication, and sales management. Through his experience, Ben has developed a comprehensive understanding of alternative investments and the financial services industry with a deep knowledge and expertise in structured 1031 products, tenancy in commons, Delaware Statutory Trusts, non-listed real estate investment trusts, non-listed business development companies, private equity and debt funds, interval funds, and other private placement syndications. Ben holds a Bachelor of Arts degree in real estate finance from San Diego State University, as well as a Financial Industry Regulatory Authority, FINRA Series 7, 24, and 63 licenses. Ehud Gersten is a managing partner at Perch Wealth. In addition to being a licensed securities professional focusing on 1031 exchanges and DSTs, Ehud is also a licensed California attorney and real estate broker. For more than a decade, Ehud owned, operated, and it's Ehud, not Ehud. Is that Ehud? Ehud. Okay, I'm just going to start from the top and say it right, actually.
Words.
Ehud Gersten is a managing partner at Perch Wealth. In addition to being a licensed securities professional focusing on 1031 exchanges and Delaware Statutory Trusts, Ehud is also a licensed California attorney and real estate broker. For more than a decade, Ehud owned and operated a highly successful law firm in San Diego focusing on real estate and consumer rights. He has advocated on behalf of many clients, including HOAs, real estate developers, investment property owners, both California and federal courts. He is also admitted to practice before the U.S. Supreme Court. Ehud has been repeatedly recognized by his legal peers as one of the top litigators in San Diego County, featured multiple times in both Super Lawyers Magazine and San Diego's Best of the Bar. He has been interviewed and featured for his national real estate work by Bloomberg, the LA Times, the New York Times, and Housing Wire Magazine. Ehud holds 2 degrees from University of Auckland in New Zealand, a Bachelor of Arts in Political Science, and a law degree. He holds a Master's of Laws and Letters degree with a concentration in intellectual property from Boston University. He holds Financial Industry Regulatory Authority Series 7, 66, and 63 registrations. Gentlemen, wow. Quite an introduction for both of you. Let's jump in. We just covered your impressive backgrounds. Let's kind of go into how did each of you get into commercial real estate, respectively?
Go ahead, Hood. So my background, I was a lawyer, attorney in San Diego, and really focused on real estate litigation and consumer litigation. And in addition to that, as you mentioned, I got my real estate broker's license. And several years ago, a very good friend of mine who's also an attorney, trial attorney that we used to try cases together, he decided to retire and decided that he was going to do a 1031 exchange. And at that point, he had asked me for some help with the exchange as his friend and trusted advisor. And while I was researching, I was familiar with 1031 exchanges, and I thought I knew everything about 1031s and real estate. Turns out I did not. And in that process, I discovered Delaware Statutory Trusts and found it fascinating. So much so that I decided to leave the world of litigation after 15 years and pursue really, the securities world, the finance world, and specifically the DST world of 1031 exchanges. And I thought at that time, and I still think to this day, that it is a fantastic solution for a lot of investors that are looking to do a 1031 exchange. So that's how I got into it.
So, I grew up in a real estate oriented family, if you will. My father was always in the foreclosure business and and private lending business, frankly. And so commercial real estate or investments, finance was always just a part of my life growing up. I went to school, of course, and majored in real estate finance from San Diego State, and was fortuitous enough to fall into um, a job opportunity in the real estate securities industry, which I had never ever thought I didn't know existed at the time. So that was my entrance into commercial real estate, and it's where I really got into 1031 exchanges and the private real estate industry as a whole.
Excellent. So I'm curious, when you went to school in San Diego, at San Diego State, where did you live off campus? Was it OB or PB? One of those
PB, Pacific Beach, 1120 Thomas. I'll
PB?
never forget. That was a memorable location for all that were involved.
So, how did the two of you link up and form Perch? How did you guys work a deal
Yeah,
together?
I,
What's
I
the
love to tell
backstory?
this backstory. Again, out of college, I jumped into the securities business, and I spent 15 years and I'm 15 years on the investment management or investment syndication side of this business. And so I was acquiring real estate. I was doing due diligence and underwriting, structuring all sorts of private real estate offerings. But part of my role was, meeting with and educating financial advisors and other professionals, CPAs, attorneys, and such, nationwide. And just to keep this story fairly short, I got an email one day from the home office that Ehud Gersten had reached out, and I looked on FINRA Broker Check, which is where everybody should look at their financial advisors to check their credentials and whatnot. And I saw that Ehud was new to the securities business. And I was so busy at the time, but I make it a practice to call everybody. And so I called the Hood, and we ended up meeting very shortly after, probably the next week. And again, fast forward, we had that meeting. I walked out. I remember I called my wife and I said, Lindsay, if there was ever a time for me to jump to the financial advisor side, it would be with this gentleman that I just met, Ehud. He's new to the securities world, but he's incredibly brilliant. He's very well connected. He's honest. He's ethical. He's genuine. This is the guy that I would do it for. And again, 3 years passed, and I ended up leaving that side of the business to open up, my own shop. And again, fortuitously, Ehud and I were always in touch since the day we met, and we talked, and our interests were always aligned and are today, and that's where it began. So yeah, it's a pretty interesting, exciting story from my perspective that I enjoy telling.
And Ehud, where were you at that time? During that first meeting, you were just getting started with securities. What kind of led you to make that meeting to begin with?
Well, one of the things that I had been at that point, I think it was 15 years, I'd been a trial attorney and appellate attorney. I'd done a lot of real estate, trial work, I had published law cases, and I felt like, I was fairly accomplished in the world of law. And I decided to leave litigation and, sort of venture out in this world of securities, which at the time was brand new. And I was very fortunate to meet Ben because um, not only is he a gentleman, but he knows this industry better than anyone else that I've met, and that includes some of the sponsors, people top at the sponsor level. So when we met, he was not just um, a sounding board and somebody that I could reach out to for advice and help, because I was green, in the world of securities. It was a brand new industry to me, but just a gentleman as well. So it was very helpful. And then when we reconnected after 3 years, it's been a pleasure working with Ben because he and I see things, pretty much the same on all things, especially the fundamental things. I come from the background of law, and I was taught from an early age. Law just reinforces that your clients come first. You have a fiduciary duty to your clients. You have an obligation to make sure that you put their interests first. And that sounds, to many advisors, that's just easy to say, and it's just words. But Ben and I truly live that, and especially in my background in law, where it's drilled into you, client first, client first, client first, and you do everything you can to make sure that you get the client the best result. So when we met and we started Perch, that was really one of the catalysts that we believed, and we thought that this is really the best way to do business, where you represent your client to the best.
Awesome. And it goes for, I mean, anybody in any industry that's watching this. Surprisingly enough, if you put clients first, then all of a sudden you're surrounded by clients. Word gets around really quickly when you do things the right way. So let's jump into today's topic: Delaware Statutory Trusts, or DSTs. Let's just explain like I'm five. What's a DST?
We'll hear from the attorney first.
So, the DST structure has actually been around since at least the late 80s or mid 80s, and it was set up under Delaware law as a business trust. And the original idea behind it was essentially to hold property in the form of a trust, and it evolved into what we consider the DST today. Even though there are still DSTs out there that have nothing to do with what we do, which we'll get into in a little bit. But really, in the late '90s, early 2000s, there were people doing exchanges. These big, what we call sponsors, out there buying real estate and offering it to investors to do their exchanges. And yet they weren't sure that what they were doing is putting people into these DSTs was actually going to pass muster with the Internal Revenue Service, the IRS. And so the DST structure became really popular primarily, after 2004, when the IRS came out with a revenue ruling and said that the DST qualifies as like-kind exchange for someone doing a 1031 exchange. So, there's a Nevada statutory trust. There are other states that have the statutory trust, but people really like the Delaware statutory trust, because Delaware in general, there's the reason a lot of companies incorporate in Delaware is there's a lot of consistency in their case law. There's predictability that you find that you don't necessarily find in other states when it comes to regulations and rules. So that's sort of a view from 30,000 feet about DSTs, and Ben can just add whatever he thinks is appropriate.
Yeah, I mean, I'll keep this brief. As Ehud said, I mean, the DSTs have been around since the 80s. They were legitimized or validated by the IRS in 2004 under IRS Code 2004-86. And essentially what it allows for is fractionalized ownership. The trust structure itself, you have one trustee that oversees and manages the trust on behalf of up to 499 beneficial owners. So again, as it applies to real estate, it's created a great vehicle for fractionalized ownership to allow investors that are doing 1031 exchanges to invest some or all of their proceeds into a DST or DSTs and have the opportunity to defer the taxes under IRS Code 1031 and really take on a passive management role and collect passive, monthly income.
Now, how liquid is a position in a DST? Let's say somebody is coming out of an exchange. I know, at least from my experience when I was in brokerage, a big 1031 exchange upleg that was popular was triple net retail triple net properties. A lot of times with corporate guarantees, publicly traded companies. What are some of the advantages that a DST has over, let's say a triple net, retail triple net single tenant property?
I'll jump in here. So it's not so much it's the sector itself isn't so much the issue. DSTs in general, and this is one of the risks or potential cons for investors that are looking at DSTs. And for some, it's not a con, but if you invest into a DST, you are essentially giving up control, right? So if you sell your own property, you exchange into a DST that is managed by that single trustee, as we just mentioned. You are giving up control. So you're not involved in the investment at all. There's no say from the investors. You are really putting your full faith and trust in the sponsor and management team that has acquired and is overseeing the assets or the real estate. In terms of Yannis, you mentioned single tenant triple net. There are DSTs where you have a single tenant triple net asset, and there are DSTs that have multiple properties within that DST. So again, just think of it. There's a trust. You can have one asset. You can have 100 assets within that trust. All right. So
Right.
So again, the important point or thing to consider for investors is that if you get into a DST, there is no formal secondary market. You can't just sell your DST interests if and when you please. Of course, or I shouldn't say of course, you can transfer ownership if you were to bring a willing and able buyer to the table, or Ehud and I were to bring a willing and able buyer to the table to buy out the interest that you've invested in, we can facilitate that transfer easily. But again, there is no secondary market, not like publicly traded stocks. So if you go into DSTs, you have to view them as long-term investments, 5 to 7 year term, at minimum.
Right.
And the other thing I would go. Sorry.
No, please.
Well, the only thing you mentioned advantages as well. So we talk about the two things that sometimes people have to accept with DSTs is, like Ben was saying, the lack of liquidity, and then it's legal to sell your interest, right? But there's, like Ben was saying, there's no secondary market, and you're giving up control. You're giving up control of the management. And for a lot of people that have built their wealth, they're in their 60s, 70s, 80s, or even younger, that have bought real estate and have managed it themselves for a long time, giving up control over that management is sometimes a challenge for them. But on the flip side of that, you have some of the largest real estate companies in the country that are managing these assets on your behalf. And these are companies with, asset management team, property management teams, billion-dollar companies that are managing your asset on your behalf. And so one of the advantages of DSTs is that they are completely passive. You don't have to do anything at all. Some people refer to it as mailbox money. Of course, there's, being in the world of securities, there's never any guarantees. We have to repeat that over and over again. But typically, you're going to see a situation where the DSTs are passive, where the investor doesn't have to do anything. For a lot of our investors, they love that because they can invest in a DST and, they used to take phone calls from tenants complaining about, toilets and trash and, termites, whatever it might be, having to fix a new roof. You never have to deal with that with the DST. The other, I think, significant advantage in a DST, and this is really important, is diversification. One of the things that, if you were to go to your stockbroker and say, I've got $1 million to spend and it's my entire life savings, and that stockbroker was to tell you, okay, put all that money into one stock. Well, if that's the world's best stock, that's still risky, right? Because you want to diversify. A good advisor would want you to diversify. It's the same in the world of real estate, and especially with DSTs, it allows you to diversify in a way that you otherwise couldn't necessarily diversify when it comes to traditional real estate. So, for example, if you're selling your property for $1 million, you're looking to do $1 million exchange. If you were to go out and buy direct, chances are you would buy a property for $1 million or more, but you couldn't necessarily go out and buy a 10 or 20 or $30 million property. Most people cannot do that. But with a DST, you can take that $1 million and you can diversify that investment into multiple DSTs. The minimum investment in a DST is $100,000. So if you've got $1 million sale from your downleg property, you could technically go into 10 different DSTs. So you're mitigating that risk because now you're diversifying your investment over multiple properties. And those multiple properties are not just geographically diversified. They can be diversified by asset class. So you can be in, to your point, Yannis, triple net. You can be in senior housing. You can be in multifamily. You can be in industrial. You can be in self-storage. So you're mitigating your chances. You're not eliminating investment risk. It's almost impossible to eliminate investment risk. But in anything, but you can certainly be in a position where now you've lowered your chances of failure and increased your chances of success. One other point I'll say regarding triple net is that when you invest in a direct real estate in a triple net, if you have a situation where that particular tenant, right? If let's say you buy CVS, you buy Walgreens.
I was just about to say the same. It actually sounds like a lot. It sounds like there's a lot less risk associated with, at least in my opinion, if I were doing an exchange, putting all your eggs in one basket as, a triple net. I mean, you're still losing control the same way that you would be, in the DST scenario. You're hoping that the tenant's going to stay there, that their company does well, that if they close locations, they don't close yours, right? So much of the value of that investment is tied up to that lease, right, of just one location, one company. Whereas, if you could diversify that and really, you can not only split it in different baskets, but each basket has different baskets in it as well. So it sounds like there's a lot less risk for the amount of, management that you're foregoing in both scenarios, right? I'm surprised that more people aren't doing this right now and are exchanging, into, a single asset, upleg.
I agree. And I think the reason a lot of people aren't doing it is because a lot of people are not familiar with it. I mean, for example, when I got into it, I was a real estate attorney. I thought I knew everything about real estate. And since then, I've spoken to real estate attorneys, tax attorneys, real estate brokers throughout the country. Many don't know about DSTs. And, one of the exciting things about doing this show or podcast and interview is that more people can find out about them. And the power that DSTs have as a tool. To use the triple net example, I had a client 2 years ago, I think it was, that was considering buying direct before he spoke to me, buying direct. And it was a Starbucks. And the Starbucks, it was just outside Chicago. And I was talking with them and I had mentioned to them, I said, Starbucks,
3.5 cap.
I believe. Well, it wasn't just the cap rate. It was right after COVID had started. And I had mentioned to him that Starbucks had sent out a letter to all their landlords, essentially telling them at the time that they were not going to be paying rent, or there's a very good chance they're not going to be paying rent. And I told the person, I said, look, what do you do, right? As an individual investor, you've put all your eggs, your $2 million that you worked for your entire life, and Starbucks, which is a credit company, right? Grade A credit company, they come to you and they say they're not going to pay you. Now they're in breach of contract. But what are you going to do? You're going to sue them. You're going to spend years, with attorneys and you're not going to get any rent. Whereas if you're in a DST structure, right, and you've got a multi-billion-dollar company representing you as a trustee, they have a lot more negotiating power to deal with a situation like that. And Starbucks is not your only tenant, right? Even if Starbucks stopped paying you, in that portfolio that you're in you've got a CVS and a Walgreens and a Dollar General and a family store, and you're in whatever else, and you might be in other asset classes.
Right.
Yeah. And I'll just comment on that real quick. I mean, that the DST really is unique and widely unknown solution. And it's really what makes our job fun, because there are so many real estate owners today that frankly are dreaming of a solution like this. They're just not aware that it is available, right? I mean, I'm just speaking, to the audience. I mean, baby boomers and seniors that have acquired and owned and managed real estate for 20, 30, 40 years, they're tired of active management and they do not want to pay tax. They also don't want, so what are their options? Aside from the DST, they sell and to your point, Yannis, they buy
You get
another
on the
triple net,
1031
right? They buy a
merry-go-round.
triple net.
Yeah. Back on the
Right.
Ferris
And
wheel for another round.
that's what's so exciting for us, is because we're able to introduce truly a unique solution to so many folks that provides so many benefits, right? The passive income, the reduction of risk through diversification, the non-recourse debt that they can assume, which maybe we'll touch on in a little bit. The surety of close, especially in today's market, right? Surety of close is just not there and hasn't been there for many years with financing and the market the way it is. And again, lastly, and the big driver here, and not to take away from, again, we talked about the risks or the downside. And for some, giving up control and not having liquidity is a deal breaker. And so DSTs are not good for them. But for the folks that are, they don't want control and they want the passive monthly income, DSTs are just a tremendous solution for so many. And the last thing I'll say is, because it's important, as your audience goes back to their CPAs or attorneys or realtors or brokers, it's important to note that, again, 95% of all those professionals, including the most sophisticated real estate investors on the planet, they are not aware of DSTs. So that's an important point that the audience should know.
So,
and I'll add one other. Well, the other thing I'll just add as well, just to follow up on Ben's point, is a lot of people, that say, well, we don't like that lack of liquidity. We don't like that lack of control. But the great thing about DSTs as a tool is they're also used as a quote unquote sort of as a potential insurance, right? So if you're doing a 1031 exchange and you're saying, okay, I'm going to buy direct, I'm going to go buy that Walgreens by myself. When you're identifying with your qualified intermediary or accommodator, it's good to have DSTs as a backup, just in case you're not able to close on that primary option. You have that as a backup. And also for people, let's say you've sold your building for $1 million and you've bought something for $800,000. You've got $200,000 left. You don't want to pay, boot on that. You can use a DST as a filler, right? So it's very malleable. It's a powerful tool to use as a backup.
That's actually very interesting. So I'm going to play the role of unknowing owner and ask a couple of questions. What about debt? And I know you start touching on it a little bit. Let's say, I bought this deal in 85 for 200,000. I've exchanged it a couple of times. Now I sell it for 3.5, but I've got $1 million of debt on it. I got a bunch of gain, but I got to replace the debt. And, in today's market with interest rates where they are right now, I'm probably pretty cap rate sensitive. And it's probably making it really difficult for me to even jump into the stream and, pull the trigger on exchanging.
Right.
What
Yeah.
do you do
I'll
about that?
jump in on that one. So again, one of the huge benefits today, especially today, is the debt or the leverage side on the DST. And again, um, uh, IRS Code 1031 exchange states that in order to defer all taxes on the exchange, you need to acquire real estate of equal or more value of the property that you sold. So let's just take a $2 million, a client or an investor sold a $2 million asset that's 50% levered, right? So they sell the property, they pay off the first mortgage. You have $1 million that goes to a qualified intermediary. And that $1 million you're going to take to buy property, and you're going to need to lever up 50%, because you need to buy at least $2 million worth of real estate. And so in the case of DSTs, the sponsor company, right? And again, the sponsor is the real estate company that went out and bought the real estate, financed it, syndicated, and is now offering it as a DST. So the sponsor company is the sole guarantor on that loan, right? And so investors, and again, we'll just use it's a $100 million multifamily DST, in Dallas, Texas. And the sponsor got 50% leverage on it. So they're raising 50 million of equity, and there's a $50 million loan. If somebody comes in with $1 million investment in that DST, they're going to get $1 million of debt along with it, right? Now that debt is non-recourse, right? It's not a liability on their balance sheet, but they get all the bells and whistles and benefits from that debt, interest write-off, depreciation, expenses, so on and so forth. So DSTs, again, especially in this market when interest rates are 6 or 7% and deals just are not penciling, DSTs are tremendous, because you can come in with your equity, exchange into a DST or multiple DSTs, and satisfy your leverage without going to the bank, without taking on liability. And so, that is the power of the benefit of the debt on the DST side.
Wow. That's huge. I guess next question for me, if I'm considering this, is what happens after I pass, and my kids, my wife, those that survive me, they get a stepped up basis. What happens to them in that scenario with a DST?
Who do you want to go? You take it.
Sure. So if you've invested, well, let me take one step back. DSTs are also used as a estate planning tool. Many times we have clients that, let's say a client is, elderly or whatever age actually, but let's say they got 3 kids and they've got one property. They've got, $900,000 to keep the math simple. Rather than investing in one property, they can invest in 3 different DSTs. Each DST is $300,000. So when they leave in their estate, whether it's a will or their trust, and they leave, one DST to each child, right, worth, $300,000. So it becomes a really good tax planning tool. If the investor dies, passes away, and yes, of course, their heirs get a step up in basis when that DST sells, and they typically, historically, they'll be held for about 5 to 7 years. Then just like any other 1031, the heirs, whoever receives that DST, can, they can essentially cash out, at that point if they chose to. They can do another DST, but at that point they don't really.
Yeah, and again, I mean, and we deal with this all, so many times, frequently. If an investor exchanges into an LLC exchanges into a DST, and there's three partners, or a trust exchanges into a DST, and there are three beneficiaries, being the children. Um, Again, upon passing, those interests are automatically divided up and allocated to those beneficiaries on a pro rata basis. So again, from an estate planning perspective, it's a great solution. And I'll say, there are many many of our clients out there um, are in situations where maybe their kids do not want to manage their real estate, or frankly, they don't trust their kids to manage their real estate, or they don't want their kids to have the assets, upon death. Again, the DST is illiquid. The beneficiaries are do receive the income and ultimately the value of the real estate when it's sold. But again, from a passive nature, and they can be very beneficial in both those instances or circumstances, if that made sense.
The other thing, just going back to what Ben was talking about, the debt before, one of the nice things about DSTs when it comes to the debt component is that if somebody, let's say, their cost basis is extremely low for the downlit property that they bought, and they go into a DST that has more leverage, then they get a new depreciation schedule that they can then write off on their Schedule E on their taxes. So it's and again, they're not on the hook for the loan, right? It's non-recourse to them, so they get all the benefits of the loan from a tax perspective, from an exchange perspective, but they don't have the liability on that side as well, and that becomes very important as well, because we've got clients that have own outright their properties, and we create a portfolio for them if they're debt free and they need a new depreciation schedule to help offset some of that income, right, to protect that. Then they can take on some measure of debt to do that,
Right.
and it's fairly easy to do with the DST.
Wow. I admittedly, going into this, I did a little bit of homework to try to see what Google could teach me about DSTs before I got here. And really, the information that's out there isn't very good in terms of helping people understand how powerful of an investment vehicle this is if you're in this space. Wanted to take a little bit of time now to kind of pivot and talk about just the market in general. Being entrenched with DSTs gives you a very unique perspective of seeing a lot of different clusters of investments together, and working with some of the most experienced owners and managers of commercial real estate in the country. What insights can you share with our audience in terms of the trends that you're seeing right now? What's performing well, what's underperforming, right? If your father-in-law said, "Hey, I've got to put this 800K somewhere right now," what kind of DST would you be pointing him towards? Before you jump into, how does one learn the difference? I know that for people that are used to traditional 1031 exchanging, there is a bit of a learning curve when it comes to, okay, what am I looking for? I want something passive, maybe a triple net. Okay, what's a good tenant? What's a good lease, right? There's so much to consider. How do you go about starting to understand DSTs, and then kind of give us a little bit of your, I guess, thought process on how you're selecting things these days?
I, I, I'll answer just the first part. We're learning about DSTs. Well, first you can go to our website. We put out a lot of educational content. When Ben and I started Perch, one of the things that we really wanted to focus on was educating clients and explaining to them, and for them to understand, what they're potentially investing into. And we have a saying we don't sell, we educate our clients, because we believe that our clients, they're all smart people, and even the ones that end up deciding they don't want to do a DST, we enjoy speaking to them because they've learned about DSTs and potentially in the future they'll do them. But DSTs offer such an amazing solution to them that they just have to be educated about it. So they can go to our website, they can call us. We're always happy to spend time and talk to folks and kind of dig deep into the weeds, as deep as they want to go about it. Regarding your second part of your question, Yannis, I think it really depends when we're talking about assets and what is good right now and what's not so good, what's going on in the market. Right now, what we're seeing, everyone's seeing in the market in real estate, everything is slowing down. So we're seeing a lot of that. What we were seeing for the last 6 months to a year are difficulty in closing on direct real estate, which again makes DSTs that much more attractive and powerful. Sales have slowed down in the real estate. We're seeing a lot more people that are having trouble closing on their properties, not necessarily because the seller doesn't want to do it, but because the buyers aren't able to qualify many times for getting their financing. That's one issue. And so I think it really depends on where you want to invest and what you want to invest in. For example, you might want to invest in multifamily, but one of the things that you want to consider is, where do you want to invest in multifamily and what type of multifamily? Are you looking at Class A? Are you looking at Class B? Are you looking at a tax-free state like Texas? Are you looking at a place like Idaho? Are you looking at senior housing? What are you potentially looking at? And so there's still attractive deals out there, but I think they're harder to come by. And one of the things that DSTs offer is that you've got some of the largest companies in the world that deal with real estate on a daily basis, where we can see exactly what the trends are on a macro level, right? We can see that, Cantor's, we're talking to Cantor Fitzgerald, and they're telling us that they're having a much more difficult time getting higher leverage on the DSTs because it's not penciling out, right? So they're putting more cash down on their multifamily in Houston or in Dallas or wherever it may be. And then we get to see what's going on in the local market in industrial, right, in Ohio. I'm trying not to go too far. It's a pretty broad question, but I'll let Ben kind of jump in too. But it really depends. A lawyer's favorite answer. It depends.
There you go. So let me see how I'm going to go after that question. There's a couple different levels. I mean, just broadly speaking, real estate speaking, we've believed, and this has been for a couple of years now, that folks should really be looking at investing in defensive, resilient strategies, right? And whether it be, again, a single tenant triple net with a $50 billion market cap company, investment rating with a long-term lease, or in multifamily, simply because not simply, but there is a supply demand imbalance across the nation. Same thing goes with assisted living, industrial. There's major demand. So now, in our opinion, is not the time to be taking excessive or simply be taking risk, right? You want to stick with the sectors and the companies and the tenants and the locations and the markets that are going to perform in good or bad times. And really, that's where Ehud and I and our team come into play, because I'll tell you, this is a little industry information. There are 35 active DST sponsors in the market, right? Again, a sponsor is a real estate company that is syndicating DSTs. We do our 99% of our business with 10 of the 35. Not to say that the other 25 are bad by any means, but given our experience, and my experience goes back, 18 years. So I've been in this industry on the other side of the business with the sponsors through ups and downs. I've seen how they've behaved. I've seen how they've treated investors through good and bad times. Obviously, we look at the fee structures, the viability of the investment strategy. So again, it's not that the 25 that we don't do business with are bad. We view them as having inherently more risk based on some of those examples I just gave. And again, going back to my initial point, now is not the time to be taking excess risk. And so, again, we kind of laid out the sectors in our investment thesis or belief today and going forward in the near term.
No, I mean it does make a lot of sense. I mean, it definitely speaks to your longevity in this space. That of 35, you've kind of narrowed it down to like, look, these are the 10 that we really like, and there's a reason for it, right? I know people know if they want to find commercial real estate, they can go to Crexi and find deals across the country, hundreds of thousands. But they don't know who are these DSTs, what do they have? And unless you've been in on the inside, right? And you can go to somebody that has that information, there's not let's just say not a wealth of info out there already.
Yannis, and
Unless you
I'll
go to
just
their
comment.
website.
You brought up a couple of points I just want to touch on, and that's really where, again, me leaving the sponsor side of the business after 15 years. As in any business, you get to understand the business and you see where there's good and bad. And there was a wide open lane or channel in this business still today that investors are not getting the quality of service they deserve, and equally, if not more important, they're not getting the informed, objective advice they deserve. And I'll just give you a quick example. I mean, I would characterize 50% of the folks that work on our industry are really just chasing a commission, and they're trying to close a transaction. I mean, there's no other way to put it. The other 50% that do business in this space, their heart is in the right place, but they have no idea how to operate in this industry, right? They're doing stocks and bonds and mutual funds and annuities and life insurance, and their client comes around with a real estate deal. And yes, they want to help the client, but again, this is foreign territory, even for the most sophisticated real estate investors, CPAs, attorneys. These come with a 300 or 400 page PPM prospectus, and they have no idea where to start. And we review these, on a daily basis. I've reviewed thousands of them. I've structured thousands of them. And that's really the value, again, the value that we bring to the table is helping investors that come to the space and that determine that DSTs are a good fit for them. We help them navigate and do that underwriting and due diligence and show them, who we believe at least are the best sponsors and who are the best and who has the best investment strategies today based on underlying fundamentals.
Awesome. Wow. This has been a very informational and kind of an eye-opening conversation. Before joining Crexi, I was a broker at Marcus & Millichap. Try not to hold that against me. Not just kidding. Love you, Marcus. Engaged in, I don't know, maybe 20 to 30 1031 exchanges over, the 4 or 5 years I was a broker. Not once did anybody bring up on any side of any transaction a DST. And I'm a little aghast at the fact that it, has so many benefits and can actually be a great solution. It's surprising to me that this tool isn't more well known about. Before we call it and wrap up here, is there any information that you want to give investors that are looking into getting into DSTs right now?
I think, from our end, one thing is that, like I said, we do have resources on our website. Even if somebody doesn't want to do DSTs, or even if they don't do it with us, I think they'll at least they should be educated about DSTs as another tool, another arrow in their quiver, so to speak. And I think as well, when you're looking to do a DST, you really, and Ben touched on this, you're really relying on your advisor to make sure that they know what they're doing. And so you want to make sure that they understand, they've done their own due diligence, and if they have, what have they looked at, that they can, look at the sponsor, tell you why. There's always a pro and a con for every deal, right? And we look for as many pros as possible. Obviously, if there's no cons and that can happen, then that's fantastic. But you really want to do your own due diligence, and the job of an advisor that's talking to you about a DST, they should be able to be there. They should be doing their homework ahead of time. They shouldn't be offering you a DST and just throwing something at the wall and hoping you happen to like something and then it sticks. There really should be a concerted effort to understand the offering before they bring it to you and explain to you why they think that offering is good. And the track record of the sponsors is incredibly important. But having said that, in the last 10, 12 years, if you threw a dart at the wall, you probably would have made money in real estate. And that is quickly changing, because the economy is changing. So just because, a company or sponsor or, a syndicator has done well in the past, you really have to understand their management team. You have to understand why they did well, and what asset classes are they looking at, because past performance is no guarantee of future results. And so we want to make sure that whoever you're going to be investing in, without picking on any particular sponsors, it's not just their track record, is what is their formula, what is their thesis, their thought process in that particular investment that they're offering to you, and why do they think it's going to work in a year or two where potentially everything is going to be in dire straits, right? So without being negative but being realistic, so you want to be protective. And the other thing I'll just add to this as well is that, with the number one job for any advisor offering anything to anyone, is protection of principal, right? Principal preservation. Number two is cash flow, and number three is appreciation. So appreciation is the cherry on top. Ben and I are always focused, and our team is always focused on advising people on investments that will protect their principal, and that's our number one job.
Yeah, and look, we have a team of 16 advisors on our team. We're in 25 in total, including staff and transaction coordinators. So feel free to give of course, I would encourage you to call us if you have questions about 1031 exchanges, if you have questions about the DST industry. Maybe now's not the right time for you, but you're interested in it, going forward. Give us a call. All of our folks are very, very qualified: MBAs, CPAs, JDs, CFAs. That's one of the things we've prided ourselves on. Is when we started this company, we were going to hire the very best in the industry. So we have all the resources, and we'd love to talk to anyone if they have questions.
Well, thank you again for joining us, and it was honestly a pleasure to hear your insights, especially on such timely and important topics. We appreciate your time today. I know you're both very busy, so thank you for making the time to sit down with us this morning.
Thank you, Yannis.
Thank you,
Shanti,
Yannis.
very much appreciate it.
And then
it's fun.
let's get the website URL and anywhere on social media or some email addresses that people can reach you if they're watching this right now and they're just listening.
So it's Perch Wealth on LinkedIn, Perch Wealth on LinkedIn, and then perchwealth.com is our website. We have a lot of stuff on there. We got educational materials, we got educational videos, articles, information about 1031s and DSTs. Those two. We've got a YouTube channel. If you look up Perch Wealth on YouTube. We haven't yet hit Instagram or TikTok or anything. I don't know that that's necessarily where people are looking up DSTs or 1031 exchanges, but you can certainly find us on
You
YouTube.
would be surprised how it's starting to creep in there. There are definitely like finance and investment, TikTokers that go over some very basic rudimentary stuff. I think you would blow people's minds if you guys were starting, some content streams on some of those other platforms, because the bar is very low as far as competing out there for this sort of
I
thing.
agree. Yeah. So I'll just real quick, you can email me or Ehud. And my email is B Carmona, Carmona at perchwealth.com. My cell phone number is 818-269-4972. Again, 818-269-4972. Feel free to reach out to us. Our contact information is on our website. And we look forward to speaking to you. Thank you, Yannis. It's been a pleasure.
And thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit go.crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app and check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.